Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra as always. And today, Sonal, we have a very interesting topic because we have 20 new fund offers which opened this week itself. That's NFOs, if you've heard of that. And these are basically new funds which are coming to the markets, right? So you have 20 new of those to pick from. How do you study these? How do you decide if it merits a place in your portfolio at all or not? So we have lots of questions and we have just the person to answer it.
Oh yes, we do. It's like the March and rush, right? So many NFOs. So of course, we'll get you a masterclass on just that. We have with us Salonee Sanghvi, who's the founder at My Wealth Guide, to talk about new fund offers. Salonee, good afternoon. Always a pleasure speaking with you. Well, as Pavitra said, 20 NFOs opened this week itself. So first up, the basic. What are the key points to check when an AMC launches a new fund?
Thank you so much for having me on the show, Pavitra and Sonal. So as you said correctly, a new fund offer or an NFO is the first time subscription offer for a new scheme that is launched by the AMC. Once the NFO is open, the fund is open for subscription again, and investors can subscribe at the prevailing NAV. So now if one is keen to invest in an NFO, let's look at some of the factors that one should definitely value. The first is the AMC's reputation. Older AMCs have multiple funds in the market, so one can look at how the funds have been managed during up and down cycles. The fund manager track record. Now, along with the AMCs, it's also important to gauge the fund manager's track record in other funds that he or she currently already manage. The third is the objective. What is the objective and the motive behind the NFO? Is it an entirely new category or theme for the industry, or is it just a new category for the fund house? For example, say if you have a new dynamic asset allocator fund, is the asset allocator model different from those of other funds already there, or is it the same? Also, in case of, say, for example, equity fund, is the investment style something different from what is currently already available? And the fourth is obviously the returns of other funds in that category, if it is an already existing category. Look at the other funds in the category to see the kind of returns and, more importantly, also the risk associated with that category. So I think anyone looking at NFO should definitely consider these factors.
Okay, that is definitely useful, and you don't have a track record for this fund, but you can look at other funds in the category to see how they've been faring. But Salonee, how does someone decide if this NFO merits a place in their portfolio, because they don't have the track record to really rely on, right? That's one big factor which is missing. So how do you decide that, okay, I like this, should I keep it in my portfolio or not?
So that's a very good question, because as you said, there are a lot of NFOs being launched, not just now, but even in the last few years. And a lot of people are subscribing to them without really understanding whether it's right or not for them in the first place. First, the investor should understand what is the right asset allocation for them based on the time to goal or duration of holding the investment and the risk-taking ability. Then look at the existing portfolio to see whether there are any gaps or is any restructuring required of the portfolio. After this, if there are any NFOs that fill the gap, then they should consider, and only then they should consider adding it to their portfolio. Now, two benefits of NFOs could be, one is, exposure to new strategies. There are some strategies that have gained momentum lately, like, factor investing, themes like EV or innovation, etc. Now, there are not many options that one can currently look at. So NFOs could give you exposure to these strategies. Again, if it fits into the overall portfolio. And second is diversification. Now, besides new strategies, NFOs might also give the investor an opportunity to invest in an asset class that's completely new for their portfolio or even a new geography. For example, IDFC launched the recently launched the US Treasury Bond Fund. So this offers diversification in the portfolio. Personally, I believe that even if there are unique strategies, it is better to wait for some time and see if the theme or investment strategy plays out as intended before really investing in a fund.
That's exactly what my next question was going to be. Say if one person actually goes ahead and invests in the NFO over an existing scheme, what would the advantages be? If the NFO is from a category that has several active schemes, is there any scenario in which you would recommend the NFO over a scheme that has been in place for a while?
if there's already an active scheme with a track record, I prefer investing in that versus an NFO. This is simply because, there is a lot of data available for that scheme, and it's very easy to analyze and determine if it's the right fit and right investment for your portfolio. I think there has to be something different that sets apart an NFO for me to even consider it.
I think the thing is that a lot of mutual fund houses come out with these NFOs just in order to complete their entire basket of funds, right, and have all of the products within the same house. But Salonee, like we were talking about it, the key disadvantage is that there is no track record, right? Do you think there are certain instances when it's still okay to invest despite of that? I mean, say it's an index fund or an ETF, something like that?
Exactly. So there are two main disadvantages to an NFO. One is obviously that there is no track record. Track record helps understand the kind of risk a fund is taking, how well it does in a bull market, how well it's done in a bear market. Relying just on the fund houses or the fund manager's performance in another fund is not sufficient. So we know the broad strategy and mandate of an NFO, but we don't know what the constituents are going to be. We don't know if it'll be true to label. Whereas when investing in an existing fund, you know exactly what you're getting into. The second main disadvantage with an NFO, in my opinion, is also the higher cost. Every fund charges a fee, which is a percentage of the portfolio and gets deducted from the returns generated. This is called the expense ratio. Now, a fund with a smaller AUM can charge a higher expense ratio as compared to a fund with a higher AUM. Also, when a new fund is launching, there are various marketing charges, there's initial NFO expense, and even higher distributor commission. So this results in higher expense ratios. Now, all of this being said, I feel that there are certain exceptions when you can still look at NFOs. One, as you correctly mentioned, is index fund. So we have larger indices like Nifty 50, Nifty Next 50, etc. But we also have many other indices like market cap based indices, factor based, smart beta, etc. For example, you have the Nifty 100 quality 30, Nifty 200 momentum 30, etc. Now the fund mimics the underlying index. So you have a good sense of how the fund is going to do and what are the parameters, because the index usually has a track record and can be analyzed. Similarly, you can also look at international funds, which invest in existing funds internationally, which again have a track record. So you can again evaluate that and decide if that's right for you. Another could be, if you're getting a discount during the NFO. For example, during the Bharat CPSE, there was a 5% discount during the NFO. And you knew exactly what companies the fund was investing initially itself. So in that case, it could still make sense to look at an NFO.
Okay, thank you.
And the last, I think, is the target maturity or the fixed maturity fund. There are multiple target maturity or fixed maturity funds in the market, but they may not exactly match your time horizon. So if the time horizon of an NFO coincides with, your investment horizon, then this could definitely be a good option.
Okay. Say an NFO is coming from a well-reputed AMC and it matches with the investment time as well. Would the lack of past performance still keep you away?
So while in general, I would keep away from an NFO, if one had to invest in an NFO, I think the reputation of the AMC and track record of the fund manager definitely provides some level of confidence, because you know that they've done it in the past, so there is a high probability they will do it in the future. If we look at the 21 NFOs which were launched between 1 to 2 years, basically having at least a 1-year track record, and this is obviously excluding debt, sectoral funds and index funds. Now, out of those 21, only 8 funds, which is 40%, have been in the top quartile in the category. So historically, NFOs have not done or performed as well. And these 8 have largely come from, your AMCs like ICICI, Kotak, HDFC, UTI, SBI, Canada. So I think the AMC definitely makes a difference.
Okay, that point is well taken, that the AMC definitely, makes a difference, and it provides some kind of comfort, right, when you don't have this past performance to rely on either. Salonee, it's been a very good chat, but I request you to stay on. We do need to take a short break, but we're going to come back in just 2 minutes and continue with lots more questions.
Welcome back. You're still tuned into Mutual Fund Corner on CNBC-TV18, and we still have with us Salonee Sanghvi of My Wealth Guide. We're talking all about new fund offers. Well, Salonee, you've made it very clear that if there's an existing scheme and there's an NFO in the same scheme as well, you would go with the existing scheme, of course, with the AMC. But say you decide to invest in an NFO. Is SIP a better approach versus a lump sum?
I feel the investment mode depends on the flow of funds for the investor. This is regardless of whether it's an NFO or any mutual fund investment. So if an investor has a regular income, then that should match the investment mode, and an SIP is preferable. But if an investor has lumpy income or funds available currently, then I would recommend investing maybe over a 3-month period. So maybe 33% as the first lump sum, and then the rest as a systematic transfer plan over the next 2 months. Given that the markets are expected to trend upwards over a longer period of time, our research shows that a lump sum or 3-month STP is the best way to invest in equity.
Okay, got that. So that is on the SIP versus, the lump sum route. Salonee, in the beginning of the show, we were talking about how if you are looking at an NFO, you need to sort of go through your portfolio, see if it's a good fit or not. Is it ever a good idea to redeem from an existing fund just to buy into an NFO? Because, redeeming can also, of course, come with its own cost, right?
Of course. So redeeming an existing fund, can result in exit loads depending on how long you've held it, your taxation and other costs, which eventually reduce the returns for the investor. But supposing if the investor is rebalancing their portfolio or booking profit, then they can look at maybe redeeming from the existing funds and invest into an NFO. I think investing in mutual funds requires a long-term approach. So the investor should focus on the overall portfolio and not just jump in because there is a new fund launched.
Okay. So, when we talk about mutual fund investing, several categories of mutual funds are saturated now, right? Yet many NFOs are collecting large sums of money. What explains this?
So you're completely correct. We have 43 AMCs, and, each AMC under debt, equity, hybrid has so many categories. So that results in so many different funds that are already present. In my opinion, I think there are a few factors that contribute to this. First, I think a lot of it has to do with the marketing of the fund. Mutual funds typically launch new schemes because they want to complete their bouquet of offerings and increase their AUM. So there is always a big hoopla during new launches, and the AMCs have large distribution networks to attract investors. Next, I feel the investors are always on the lookout for new trends, innovative strategies, or new themes. And may just invest in a new fund because it sounds exciting. And this is regardless of, it may not even differ substantially from the funds that are already there. Because, just because it sounds exciting, a lot of people tend to invest in that. Investors are very influenced, I think, by the hype around an NFO. Then I also feel some people think that an NFO works like an IPO of shares. And the way an IPO can have listing gains due to higher demand on listing, an NFO will also behave the same way. Investors don't understand that while the number of shares in case of a stock are limited, there is no limit to how many units a mutual fund can have. So units get created as and when required, as and when investment comes in. So there is nothing like listing gains for an NFO per se. And also another fallacy that it's cheaper. People think that, okay, I'm getting a unit at 10 rupees, so that is cheaper than a fund which has an NAV of 500, thinking, 10 is much lower than 500, so that's a better investment, without really understanding that it has no bearing on the returns. So there's a perception that they're getting a potentially lucrative investment opportunity when it not necessarily is. So I think these are the main reasons why we see high collections for NFOs in general, especially those that already have many active funds in the same category.
Okay, that makes sense. So, Salonee, do you also think that, we've been talking so much about the fact that equity markets are so range-bound, there's all of this global volatility which is playing in. Do you think people who were perhaps trying to invest directly in equity are now moving away and picking the mutual fund route? So, in that context, it might be a better idea to start marketing with these NFOs to them?
So I feel a lot of investors, especially young investors, came in 2020 and 2021 seeing, the bull market that we had and thinking that it's easy to make money. So a lot of them went the shares route without really understanding how it works or without really understanding what they were doing. So I think a lot of people have burned their fingers and are looking at other options like mutual funds to start their investing journey. That being said, I'm not sure if NFOs are the right way for them ahead because, again, it is very difficult for them to analyze the fund to know really, especially if they're new to the market. So I feel if someone who's starting to invest should ideally look at funds that are already there.
Okay. And of course, 2022 has been a great learning for everyone who's invested in the markets in 2020, right? So just giving you some combinations, right? Here, say new AMC offering a new fund. What do you think of this combination? Is it a complete avoid for you?
Let's just look at historically what has happened. We've had a few AMCs launched in the last 2-3 years. And if we look at the performance of those AMCs, it's been very lackluster. In fact, they've not even been in the top third. I think it's very difficult to gauge because you don't know how the AMC is going to do or whether they're going to stick to the philosophy. So while there are several new and upcoming AMCs that have a good pedigree or track record, even as PMSs, I would still wait and watch for a few years to see if they're able to translate the philosophy and vision into actual return.
Okay, so this perhaps may not be the best combination. But Salonee, like we were mentioning, 20 new fund offers opened this week. Have you gone through them? Do any of them appear attractive to you or, something that you might recommend?
So a lot of new funds that are being launched are target maturity or fixed maturity funds. So I feel if they match your time horizon, then one can definitely look at them. Amongst the equity funds, I think the Axis S&P 500 could be an option for investing in US equities, especially for SIPs, because a lot of the other funds are close to RBI limits for international investing. So there are very limited options in that sense. So this could be a good option if you're looking at investing in the US market.
Okay, so that's your take. Out of the 20 NFOs, most of them are target maturity funds or debt funds, of course. And you've seen in rising interest rate scenarios what happens and how you lock it in target maturity funds. But debt, of course, there's an impact there as well. Salonee, it was a pleasure having you with us on the show. Thank you so much for joining us and telling us all about these new fund offers. Hoping to speak to you very soon. And with that, we'll take your leave on this edition of Mutual Fund Corner. But do remember to email us your queries and we'll address them with our experts, leaving you with some market opinion from Manish Santhalia, Head Equities PMS at Motilal Oswal Asset Management. Stay tuned for Closing Bell to take you through the last hour of trade.
Within the next 2 quarters, I would believe that mostly all the negatives of the IT names would get priced in. It's a great time to buy IT, and particularly the sector has seen some very decent correction over the last 1.5 years. And, there is absolutely no interest. So the sector is seeing a lot of disbelief as far as the earnings growth trajectory on FY24 numbers are concerned. Cross currency, which was a headwind in FY23, will likely become a tailwind going into FY24 and 25. So from that point of view, I would believe both IT and pharma are great buys at current levels. I would believe it's likely to remain an overweight sector for FY24 at least, even though earnings trajectory would be not as strong as we've seen in fiscal 23, but still it's going to be very decent and in line with or slightly better than what the total index, which is Nifty 50 earnings growth, is likely to shape up for fiscal 24. So I would broadly be a buyer on dips in the banking space, but more so on the private sector banking names as opposed to PSU names. In the PSU names, only State Bank of India.